Do you want to turn $100,000 into a money-making machine? Who wouldn't, right? Picture this, your money going out every day ahead of time, making more money for you so you can spend time however you want. Sound great? Well, good news, because in this video, I'm going to show you the simple ways that you can take $100,000 for passive income. It's kind of like the advice that we get from the book Rich Dad, Poor Dad. Getting your money to work for you so that you don't have to trade time for money to cover your bills. Ready to get started? Well, in today's world, the smartest thing that you can do, if you watch videos, if you read articles, whatever, is to make it grow while you focus on doing what you enjoy doing. That's what we call passive income. Your money's out there busy at work while you're not. But how do you do that? Especially with 100 grand. Well, that's exactly what we're going to be getting into today. First, let's break down what exactly is passive income. Okay. A lot of times it's tossed around like a buzzword, but passive income is all about creating streams of income that require minimal to no effort. All right. Imagine planting a tree. Okay. You get like a little 12-inch, 18-inch tree. You plant it. What do? You water it. Okay, maybe you fertilize it. It's got sunlight or whatever. But soon, what happens? It starts to grow bigger, bigger, bigger. Maybe it's a fruit tree. It starts to bear fruit. And guess what? You don't have to care for it anymore. But you had to at first. So that's the type of income. That's the kind of income that we're aiming for. Okay. Now let's talk strategy. So I'm going to discuss with you. I'm not a financial planner. Don't take this as financial advice. I'm going to share with you some different ways, kind of the quote traditional ways, some of the non-traditional ways, and then you kind of decide what's best for you. Okay. So we're going to look at, stock market. We're going to look at real estate and some other things. Let's start off by first, before you do anything, you need to make sure that you assess your financial situation. Okay. Everybody's different. Okay. So before you jump in and you want to start, you got 100 grand saved up and you want to start just putting it in all these other places, you need to take a step back and you got to ask yourself, how is your financial health? Okay. So first thing is your risk tolerance. So again, you have to figure out how you feel about risk, because how you feel about risk is going to be different than how I feel about risk. Okay. So are you sort of the play it safe type and you just like steady returns year after year, but these types of returns are probably going to be, smaller returns, okay, like bonds. So it's safer returns or typically smaller returns, or are you more of a daredevil? And you could have the potential for bigger gains, but also you could have ups and downs like the stock market. So you got to kind of figure this out. That is your risk tolerance. And it's very important to know where you stand before you start to invest. The second is this, it's emergency fund. That's basically your safety net. Okay. It's kind of like, when you go boating and you're supposed to wear a life jacket, think of the emergency fund as like your financial life jacket. And, I learned this from when I used to follow Dave Ramsey when I got out of my residency. He recommends, 3 to 6 months of living expenses. I'm actually more comfortable with more than that, 12 to 18 months. But for you and for other people that I recommend, that I consult with, I usually do enough to cover 6 to 12 months of your living expenses. Okay. So this is going to be cash that's going to be set aside. Again, it's a financial life jacket that's going to keep you afloat once something unexpected happens. Not if, it's when, because it will always happen. So tree falls on your roof, or you have, a transmission goes out or whatever. You don't have to pull out your credit card. You don't have to cash in some of your investments early because you have this money set aside. All right. Third is any high interest debt that you have. You could have some 20, 25, 30% or more debt. So you want to look at that. Do you have that? So paying off these debts with this sky high interest rates, that really should be a priority as well, because that type of debt is really going to eat into your finances more than your investments can grow. All right. And last but not least, and probably the most important thing that I'm going to tell you today, and whenever I do coaching with people, this is one of the first questions that I ask them. What do you want? Ever thought about that? You ever just stop? I know there's all kinds of distractions and things going on, but just stop and just kind of think about, what do you want? What are you after? Unfortunately, most people can't answer this question. And I'm going to tell you this, and I'm going to be straight up with you. Until you do, you're not going to get what you want, because you don't know what you want, but you're not going to have the life that you are really searching for. Because if you just wake up every day and you go to work and you just hope things change or whatever, that's like the definition of insanity, right? Doing the same thing over and over again, expecting a different result. So think about, what do you want? What are your big money dreams? Do you want to retire early? If you enjoy like what you do, well, maybe you want to get to work optional status as quick as possible. Do you want a big home to have all these your kids when they leave, they'll come back? Do you want vacation home? Do you want to travel a lot? Do you want to have a private jet? Whatever. You got to figure out what do you want, because your investments that you're going to be making, they have to be in line with your goals, with what you want. I can't tell you how many people that come into my passive investor circle and they kind of have an idea what they want. We're talking about passive income, they want passive income, and they tell me they want the ability to retire early and this and that. And then when I ask them what they have been doing for the past 5, 10, 15 years, or whatever, they're so set on putting money in investments that is not getting them, does not align with what they want. So they're putting money in 401ks, in things where they cannot access their money until they're 60, yet they want to retire by 45 or 50. And it's like it's been so ingrained in their head. So again, I'm not saying this is right. I'm not saying this is wrong. I'm just saying you've got to get really, really clear on what you want, right? So let's talk about diversification first. And I just kind of mentioned this a little bit. Let's talk about the quote traditional way to invest your money, okay? You're all probably familiar with this. The first one, stock market, right? So this is a very popular way that you can invest 100 grand to earn passive income. You can do a diversified portfolio of stocks that can generate dividends, interest, capital gains. All right, we're all familiar with that. Then you have mutual funds. Okay, a mutual fund is like a big group investment. Everybody chips in some money. Then you have this professional manager that's somewhere probably in New York that uses all this cash to buy a bunch of different stocks and bonds and other things. So really the goal is to make the big pot of money grow. So your piece of the pie gets bigger or smaller depending on how well the fund grows. Number 3 are exchange traded funds, or ETFs. These are very similar to mutual funds, except they are easier to trade and they trade just like stocks. You can just get an app on your phone, you can just buy them real quick. Speaking of stocks, the 4th is actual individual stocks. Okay. While these are riskier, but if you pick the right individual stock from different industries, that can really lead to higher returns. Think back on Amazon. If you would have gotten in when it was like $1, or Tesla or Apple or anything like that, think about what that could give you now. And then you want to maybe focus on dividend producing stocks, because that's going to give you your passive income. And last but not least are index funds. Investing in these can basically allow you to achieve broad diversification and earn passive income through the dividends it's going to give you in capital gains. So overall, the index funds, they have lower fees compared to like actively managed funds. So if you were with Morgan Stanley or Merrill Lynch or somebody like that, they typically will charge you an asset under management fee, which is higher versus you going directly to like a Vanguard or Fidelity that's going to have a lot lower fee. Now, when I first started off in practice, this was all I knew. And with following Dave Ramsey for a while, I didn't have, and I still don't have a financial advisor. I just mainly used index funds. So we had a Vanguard retirement account for my practice, put money in there. Everything left over was dumping it into index funds until I changed the way that I invest, which again, what I was doing before was not aligning with what I wanted. Thus, I changed. Again, you got to figure out what you want. All right. So that is the quote traditional way to diversify your money. So now let's go off and talk about some other ways that's not so traditional, and that's real estate, right? As you probably know, this can be a very lucrative source of passive income. But here's the thing, kind of like, what do you want? When you get into real estate, the very first question you have to ask yourself is, do you want to be active or do you want to be passive? Do you want to deal with tenants? Do you want to deal with headaches? Do you want to deal with problems? But you have time and it's okay, because I know several people in my area that are active investors, very wealthy, but they have the time to do it. They have the knowledge. Or you're like me, you have a quote regular profession or regular job. You don't have the time. You don't want to deal with tenants, problems, all that kind of stuff. So you may want to figure out and start off being passive. My personal journey, I've started off passive. Now that I've learned the lingo, I learned how things are working, I'm gradually starting to branch out and be a little bit more active. First, I started here, learning from other people. All right. So here's some options for you. Rental properties. Rental properties, that's mainly if you're going to be active. So you can go buy a single family home. You can rent it out to a long-term tenant. You could do short-term rental, Airbnb, but rental properties are typically a stable source of income, especially if you're investing in properties that have a high rental demand or in a high demand area. And if you want to do this yourself, you can, but you can make it sort of semi-passive where you can hire a property manager and you have kind of a hands-off approach, but you're still going to have to manage the property manager. Second, my favorite real estate investment are real estate syndications. Okay. So imagine pooling your resources. You're a limited partner. You're pooling your resources with other investors or limited partners to participate in larger projects. So we're spreading out it's kind of like a shared risk. We have indirect ownership with a sponsor, with a general partners, limited partners. And when you participate in a real estate syndication, you're also going to generate passive income through the rental income that's coming into the property. Could be different things. It could be people paying their rent. It could be other types of income. We own a bunch of RV parks. We're getting income from laundry facilities. We're getting income from ice. We're getting income from propane, putting in pickleball courts. So some really cool stuff. But again, you're still getting money from income, rental income. You're getting money from the property appreciating over time, going up. And then you have all the potential tax advantages like depreciation. And last but not least are REITs, real estate investment trusts. Probably familiar with this. These are publicly traded entities that they go out. Vanguard has them, Fidelity, all the big boys have them. They go out, they invest in real estate. And the thing is, these companies, they're required to distribute most of their taxable income to you, the investor. Okay. Which this kind of makes them an attractive source of passive income. But you're not going to get the tax advantages. You're not going to get a lot of the things that you would if you invested in rental properties or you invested in syndication. So again, what I wanted to do, after I hurt my wrist, I figured out if I can't use my hands, I can't practice. Okay. So that's what led me down the road from shifting from the traditional route to real estate. And again, that was a process that I went through. I could make more money focused on what I do best, dentistry. That's why I chose the passive route. Okay, so again, you got to figure out what you want, and you got to figure out what's best for you. And I figured out I could make more money initially treating patients, so I was better served at going the passive route. Now, as I'm starting to cut back, kids are moving out, I'm moving towards the active route. Now, there's multiple other sources of passive income streams out there, sources you can kind of decide on if you want to. And I kind of mentioned a little bit dividend paying stocks. You could do some peer-to-peer lending. Sometimes that offers some higher returns, but it also comes with risk. You can put your money into higher yield savings accounts and money market accounts. Right now, money market accounts are paying just over 5%. So that's going to give you just another source of passive income. So to sum it up, investing 100 grand for passive income. It's just not about, hey, I got 100 grand, I'm just going to put it into something. It really takes strategic decision making. Okay. Careful planning, looking at your financial situation, looking at your risk tolerance, looking at how much debt you have, high income debt, looking at, do you have an emergency fund? Instead of just having 100 grand, you just put it somewhere. Okay. If you can go through all this, especially what you want, then I think that you're ready to do it. But again, you have to figure out what you want, look at the different options and think, what am I doing now? And if I want to get to the point where work is optional in 10 years or less, yet all I'm doing is investing in the stock market through a 401k, that is not aligning you. You're going on the West Coast, but everything that you want to do on your trip, you want to go to the East Coast. Okay. So you have to decide on what you want to get you there. Remember, the journey to passive income, it's not just about making money, just like what we started talking about. It's about getting your money working for you. You want to figure out a way to replace yourself. So when you wake up in the morning, you go to your job, you want to think about, all these AI and robots and all this stuff. Think about, you wake up in the morning, you have a robot that will go out to your work, make the money, and basically pay for your expenses without you having to do it. That robot is going to be your money that is out in all these different investments. You figure out a way to replace yourself as quickly as possible to replace your expenses. Thus, you have financial freedom. If this video was helpful, do me a favor, like it, subscribe if you haven't already subscribed, hit that little share button, send it to somebody that you think this will be helpful to, and then comment below if you have thought about investing for passive income, and if so, which of these are you currently doing? Take care.